So the headlines are saying right now that every baby born after December 31st, 2024 and up to December 31st, 2028 are getting a free $1,000 from the government. So this is automatic, no strings attached. But here's the part that I'm seeing that's getting missed. These Trump accounts, which as of now I believe are their actual name, are not just for families with newborns. It's the beginning of a completely new account, one that can open up opportunities for certain types of families. So if you have a child under 18, even a teenager, this is worth your attention, because beyond that $1,000 of free money that's getting all the attention, there are some rules that let you contribute every year, invest tax deferred, and potentially, I think as of now, convert that to a Roth IRA down the line. So the details of this account were changing frequently up to the final version of the bill. So there is a lot of misinformation out there. And on top of that, there's still a lot of guidance that we don't know yet. So for reference, I'm recording this on July 21st, 2025. That said, I want to walk you through how these accounts work, opportunities available as what we know today. And spoiler alert, I don't think these accounts are getting all the hype they deserve, especially when it comes to middle-class families. I see a lot of benefit for high net worth, as well as lower income earners who could really benefit from the $1,000 in free money when their children is born. My name is RJ Weiss. I'm a certified financial planner, founder of The Ways to Wealth, a site that's been running since 2016. For more details and information about Trump accounts, I'm going to keep a blog post updated on The Ways to Wealth, so you can click in the description below to visit that post. So here's what we know so far. Up to $5,000 a year can be contributed to the account per child. So that's going to include contributions from parents, say grandparents, or even an employer, as you'll learn about next. Contributions to these accounts are not tax deductible, so most people will be using after-tax dollars to contribute to these accounts, and there's no federal deduction or credit for doing so. So this makes them a lot different from 529 plans, where many states offer a tax deduction or even a tax credit for contributing to one. So one thing that really stood out to me and is an opportunity for self-employed, high net worth individuals is employer contributions can be made towards these Trump accounts. So an employer, whether that's yourself or an employer in general, can contribute up to $2,500 per year per child per account. And that's part of the annual $5,000 limit. So what's interesting here is these contributions are not considered taxable income to the parent, and they can be treated as a deductible business expense. How it's going to work is you're going to invest in a low-cost ETF or index fund. The rules mandate that it has to have less than a 0.1% expense ratio. Well, for me, that's a very good thing. I think this is how most people should invest anyway in these index funds that are very broad-based, which also means there's no individual stocks, there's no crypto, there's no gold. These are invest in American company type accounts. What I'm reading is you're going to be able to then move these accounts to your brokerage of choice as long as they follow these rules. And the guidance says you can invest directly with a modern digital investment account. So not sure what that means yet, but we'll find out. All right, let's get into the withdrawals. The funds in this account are locked until the age of 18. The guidance says unless they're rolled over into another approved account. And as of now, there's no guidance on what an approved account is, however. So for me, one interesting thing is a Roth IRA. There's been a lot of speculation, could be one of those approved accounts, which then could create a lot of tax-free income later in retirement for kids today if they take advantage of, say, a transfer to, or a rollover, I should say, from one of these Trump accounts to a Roth IRA. But then again, we don't know exactly how that's going to work because the cost basis on these accounts is a little bit different from what you get with a traditional IRA. Another thing to know about these accounts is a child gets full custody at the age of 18. So this is a lot different from a 529 plan where the parent still remains in control of the account. So at the time the child turns 18, they can withdraw the money for any time, for any reason. This isn't like a traditional IRA where there's going to be a 10% penalty, but the taxes owed on that are going to be based on where the money came from. So if you contributed as a parent using after-tax dollars, they'll owe tax on the gains only, not the contributions that you made, $2,000. So say you contributed $5,000 total, the kid turns 18, there's $10,000 in the account now. So $5,000 is going to be your original investment amount, and then you're going to be taxed $5,000 as well as on ordinary income. So say the money then came from the employer and it has grown to $10,000 and it wasn't made with after-tax income of the parents, then that whole amount is going to be taxed as ordinary income to the child. So what happens then if they chose to leave the money in the account? Similar to a Roth IRA, but this is where a lot more guidance is needed. It can grow tax deferred. So where a lot more guidance is needed, does it automatically convert to a traditional IRA where then withdrawals are going to have a 10% penalty? I don't know this. I would say no, based on the idea of the account, because at the end of the day, you're going to have some pre-tax and some after-tax money in there. So there's just a lot we don't know yet. So on that note, when you compare these to other types of accounts that are available for parents these days to invest for their kids, I just don't think they're that much better in any one area to really invest in these, except a few exceptions, which I'll get to. So if you look at a 529 plan, let's compare that first. A couple of advantages these plans have is you get that tax deduction or tax credit. Qualified withdrawals of a 529 plan are completely tax-free, so you don't need to worry about ordinary income tax. And for a 529 plan, as start of last year, there's new rules that make it eligible to convert to a Roth IRA. So to do that, one of the qualifications is you need to have the account open for 15 years. And another important thing for parents when it comes to 529 plans is you really remain in control of these accounts. You can transfer from one kid to another, easily change the beneficiary. With a Trump account, you're really beholden to the beneficiary that you name the first time you open the account, and there's no transferring between kids, say if college costs get a little different from one kid to the next. So then you look at these compared to UTMAs, and I really don't think they stand out that much. So at least not yet, based on what we know today. So one of the reasons I really like these accounts is how the earnings are taxed. So say you invest in an UTMA account, it's an index fund like you would, the earnings are going to come a lot of times from qualified dividends or long-term capital gains. So for many children, especially those who aren't earning a lot of money, say after the age of 18, those types of earnings can actually be taxed at 0%. The IRS offers a 0% long-term capital gains rate for people in these low tax brackets. So as of 2025, that 0% rate applies to anyone who is earning about less than $47,000 per year. So compare that to an Invest in America Trump account where you're paying ordinary income taxes regardless of your income. While your tax rate might not be that high, a little bit can add up here. So that said, there are still some compelling cases for looking into the accounts more. I think one is a high net worth self-employed individual that can contribute up to $2,500 based on their business. I also think any high net worth family can benefit from opening these accounts. Just contribute the max amount every year. There's going to be some tax savings there. Also, I just like these accounts for those in the lower income tax brackets, having someone get $1,000 in an account that's going to grow over the years. You know, it could almost grow to about $4,000 at the age of 18. That's a meaningful down payment for some type of schooling that can benefit these lower income families going forward. So I really like these accounts for them. Even if it's just investing that $1,000 seed money, these are going to benefit them down the road. So going forward, some things I like to see is just clear guidance on what happens after the age of 18. We really don't know yet. If they have the ability to transition into a Roth IRA and that guidance is clear, that could really be a great opportunity for everyone who contributes money to their kids on this account, because they're going to have that tax-free money grow year after year, hopefully over decades. And one thing that I'm kind of like to see is a way for my kids, say I invest in Acorns, to have these accounts open and see their account growth over time. The nice thing is, like with a Roth IRA, with a traditional IRA, you need earned income to contribute, but kid can contribute regardless of where their income comes from. And I like to see my kids have this account on their own. So if they invested and tied it into Acorns, which is what we currently use, I'd love for Acorns to tie this into the app and my kids really be able to monitor this account on their own. More comes out about this. I'm going to keep watching it closely. There's a lot of things I like here. It does present some opportunities for some individual types of families. Like I said, on the low end of the spectrum and the high end of the spectrum, there's a lot of opportunities. I really do like 529 plans. Even the UTMA accounts really do provide a lot of benefits, give more control and give more flexibility for a lot of middle-class families, but we're still waiting some guidance on here. So bottom line, I wouldn't go out and make adjustments to your 529 plan today based on what we know now, but keep an eye on it, and that could change in the future.